The modern monetary system forms the foundation of global economic activity, yet its fundamental mechanisms remain opaque to most citizens. A careful examination of money creation and interest-based lending reveals mathematical impossibilities and structural contradictions that generate far-reaching social and economic consequences. This analysis explores these systemic issues and their implications for sustainable economic development. In today's fiat monetary system, money is primarily created through commercial bank lending rather than government printing presses. When a bank approves a loan, it creates new money by crediting the borrower's account with the loan amount. This money emerges literally from nothing. Banks do not need to draw from existing deposits to make loans. According to central banking authorities, including the Bank of England and the German Bundesbank, this process of credit creation generates new money with each loan and destroys money when loans are repaid. The money supply is therefore in constant flux, determined largely by private banking decisions about creditworthiness and profitability. This system effectively privatizes money creation. While central banks set interest rates and regulatory frameworks, the actual creation of money occurs within commercial bank balance sheets. Private institutions thus determine where and how new money enters the economy, based primarily on profit maximization rather than social utility. Here emerges a fundamental mathematical contradiction. When banks create money through lending, they charge interest on these loans. Consider a simple example. If a bank creates $100 through a loan and charges 5% annual interest, the borrower must repay $105. However, only $100 was created. The additional $5 for interest was never brought into existence. This mathematical impossibility pervades the entire monetary system. If all loans were to be repaid simultaneously, it would be literally impossible because the money required for interest payments was never created. The system can only function as long as new loans are continuously taken to service the interest on existing debt. This creates what economists call a debt pyramid. New debt must constantly be created to service old debt, leading to exponential growth in total debt levels that eventually becomes unsustainable relative to real economic output. This structural design necessitates perpetual economic growth. Since more money must be repaid than was originally created, continuous expansion of the money supply becomes systemically required. This expansion can only be justified through economic growth that enables new borrowing capacity. The growth imperative has profound environmental and social consequences. Companies must expand continuously not just to thrive, but to survive in a system where debt service requires ever-increasing revenues. Workers face constant productivity pressures. Society becomes trapped in an endless cycle of production and consumption, often at the expense of sustainability and well-being. This helps explain why, despite massive technological advances and productivity gains, working hours have not decreased as many economists predicted. The system requires constant acceleration to service its mathematical impossibilities. The interest mechanism functions as an automatic wealth redistribution system from debtors to creditors. Those who must borrow pay interest to those who possess capital. Since interest income accrues with minimal risk due to deposit insurance and little effort, this creates continuous wealth concentration. The Cantillon effect amplifies this redistribution. New money first reaches banks and wealthy individuals with sufficient collateral. They can use this fresh money to purchase assets before general price levels rise. Less wealthy individuals receive new money later and must pay already inflated prices without having benefited from the initial advantages. This mechanism helps explain growing wealth inequality in developed economies. The monetary system itself systematically transfers wealth from the working population to capital owners, regardless of productivity or merit. Governments operate under the same mathematical constraints. National debt functions on identical principles. More must be repaid than was originally borrowed. Economists acknowledge that sovereign debt is typically never fully repaid but continuously rolled over. Old bonds are replaced with new ones. This explains why government debt tends to grow regardless of political party or fiscal policy. Even austerity measures rarely reduce absolute debt levels because attempting to fully repay would create deflationary pressures by removing money from the system. Modern monetary theory (MMT) economists argue that sovereign debt differs fundamentally from private debt because governments can create their own currency. However, the interest burden still creates real resource allocation challenges and political constraints. Inflation serves as a necessary pressure valve in this system. Since more money must continuously be created than repaid, structural inflationary pressure emerges. Central banks deliberately target moderate inflation because it reduces real debt burdens and stabilizes the system. This explains central banks' fear of deflation. Falling prices would increase real debt burdens and could trigger cascading defaults throughout the economy. The system requires inflation to function, making price stability inherently temporary. The exponential growth of debt and financial assets creates systemic instability. Compound interest ensures that debt and wealth double at regular intervals, regardless of real economic performance. This mathematical progression cannot indefinitely continue within finite resource constraints. Historically, all interest-based monetary systems have experienced periodic crises and resets. Wealth concentration and debt accumulation regularly create systemic tensions that manifest as financial crises, often followed by wealth destruction and system reorganization. The 2008 financial crisis exemplified these dynamics. Excessive debt accumulation led to systemic breakdown, requiring massive central bank intervention to prevent total collapse. Rather than addressing root causes, policy responses typically add more debt to stabilize the system temporarily. The privatization of money creation raises profound questions about democratic governance. Essential decisions about money supply, credit allocation, and economic priorities are made by profit-maximizing private institutions rather than democratic institutions accountable to the public. Citizens have no direct say in how much money is created, where it flows, or what purposes it serves. This represents a significant democratic deficit in what should be a fundamental public utility, the monetary system that underpins all economic activity. The growth imperative embedded in the monetary system directly conflicts with environmental sustainability. A system requiring exponential growth cannot indefinitely operate within planetary boundaries. The mathematical necessity of continuous expansion drives overconsumption, planned obsolescence, and resource depletion. Climate change and other environmental crises may be fundamentally incompatible with a monetary system that mathematically requires infinite growth on a finite planet. Addressing environmental challenges may therefore require monetary system reform. Various alternatives have been proposed to address these structural problems. Full reserve banking would separate money creation from lending, giving democratic institutions direct control over money supply. Local currencies and mutual credit systems operate without interest-based wealth extraction. Some economists propose debt jubilees to reset unsustainable debt accumulation. Central bank digital currencies, CBDCs, could potentially enable direct money creation and distribution, bypassing commercial banks. However, without addressing the fundamental interest problem, such reforms might only modernize existing contradictions. This analysis reveals that many contemporary economic challenges, inequality, environmental destruction, financial instability, and perpetual growth pressure, stem from structural features of the monetary system rather than policy failures or market imperfections. The mathematical impossibility of collective debt repayment, combined with compound interest effects, creates systemic contradictions that manifest as social and environmental problems. Understanding these mechanisms is essential for developing sustainable economic alternatives. While the current system has proven remarkably adaptable and resilient, its fundamental contradictions remain unresolved. Addressing 21st century challenges, including climate change, inequality, and democratic governance, may require fundamental monetary system reform rather than incremental policy adjustments. A mature democratic society should have informed debate about these issues rather than treating monetary arrangements as natural laws. The stakes are too high, and the contradictions too fundamental to avoid this essential conversation much longer.